Hi guys, good morning. You're watching Opening Bell with me, Nandita Khemka, right here on Money Control, and it doesn't seem to be a very good morning given the fact that we saw a very sharp sell-off coming in on Wall Street overnight on the back of recession fears, tariff uncertainty, and a lot of these things weighing in on sentiment, and of course Asian markets as well, mirroring what happened overnight on Wall Street. Although last time I checked, US futures were mixed, with Dow futures trying to hold on to that positive zone, but the gains were extremely feeble. So looks like it is going to be a rough ride and a rocky start for us today as well. Yesterday, remember, we saw a sharp sell-off, especially in the last hour of trade. In fact, the Nifty gave up that 22,500 mark, which we were managing to defend thus far. Even 22,450, that was taken out on the downside. So whether or not the 22,000 level is once again, under threat in this leg of sell-off is something that we'll be really watching out for. But for now, not looking very pretty this Tuesday morning. Lots of stocks in focus. IndusInd Bank, once again, we will be talking about that as well. Yesterday it was the CEO extension issue, and now there are some discrepancies in accounting when it comes to the derivatives portfolio. So yes, expect another rough session for IndusInd Bank. It could in fact hit a fresh 52-week low today as well. But before we move any further, quickly take a look at the top headlines at this hour. Sharp sell-off on Wall Street as President Donald Trump refused to rule out the possibility of a recession. The Dow tumbles nearly 900 points. Nasdaq slumps 4%, suffering its worst day since 2022, while the Treasury yields also dipped by 9 basis points. Asian markets trade with deep cuts, tracking weak US cues amid tariff concerns and economic uncertainty. The Nikkei falls 2% after fourth quarter GDP comes in below estimates. The GIFT Nifty is hinting at a gap down start for our markets. In fact, even at the pre-open, I was looking at it, the Nifty is down somewhere around 1% at the reports. Crude prices slip further. Brent trades at $68 a barrel on worries that US tariffs on Canada, Mexico and China would slow economies around the world and hurt energy demand. Meanwhile, gold dips on profit taking ahead of US inflation data. And Maharashtra budget proposes a third airport for Mumbai, increases taxes on CNG vehicles, luxury cars and electric vehicles above 30 lakh rupees. All right, then let's take a look at the cues for trade very quickly before bringing on board our technical guest for today. Market in fact failed to hold on to opening gains yesterday. We ended at the day's low. We gave up 22,500. In fact, even closed below that 22,450 mark, which we were being able to defend thus far. But that has been violated. Broader markets, of course, were underperforming. We saw the small cap index down by 2%. Advanced decline ratio, the breadth was extremely poor, 1:4. That was the NSE advanced decline ratio. Oil marketing companies saw deep cuts yesterday because the second supplementary demand had no provision for LPG compensation. Remember, oil minister was seeking 35,000 crore rupees, in compensation when it comes to LPG, but that didn't feature in the second supplementary demand. And that was a disappointment. Autos were under pressure as well. IndusInd Bank, of course, hit a fresh 52-week low yesterday, down 3% on, the tenure of the CEO extension. But today, the stock will once again be in focus on the back of discrepancy in accounting when it comes to their derivative portfolio. In terms of, the FNOQs, Nifty put call ratio fell further to 0.9 vis-a-vis 1.08 in the previous session. BSC has been added to the ban list. Remember, BSC has been under pressure ever since the NSE has shifted its expiry day. So, BSC, after the string of losses, has been added to the FNO ban list. Manappuram Finance and Hindustan Copper are the two stocks that will remain in FNO ban today. But some bit of a breather or reprieve, you may say. Foreign investors were sellers yesterday, but the selling was sub 500 crore rupees. So the selling has been coming down consistently since the start of March, and yesterday it was really meager, so to say, less than 500 crore rupees worth of stocks sold in the cash market. DII buy was somewhere around 260 crore rupees or thereabouts in the cash markets. So the pace of FI exodus has kind of slowed down. But let's put into perspective how the charts are really poised this morning. Joining me is Osho Krishan, Senior Analyst, Technical and Derivative Research at Angel One. Osho, welcome to the show. Lovely chatting with you. Looking at the chart setup, in the pre-open, we can see a 1% cut on the Nifty already. So, what are your thoughts? How much more downside? Because we did try to, come back from lows, 22,500. We managed to reclaim that. But now, of course, that has been violated. What is the next support that you'll be watching out for on the downside?
Very good morning, Nandita. Firstly, thank you for having me at the show. Well, yes, in the last week, we have seen a very decent movement from the zone of 22,000 towards 22,600, 650 odd levels. But the last day of trading session has hinted for some kind of profit booking from the higher end that has been even further dampened by the US markets, where we are expecting a kind of a recession period in the coming period. So there is a kind of a dampener for market, and we can see some kind of further sell-off in both the key indices. For Nifty, approximately the recent development that has been seen is approximately 22,300 has been seen as a kind of a put writers have taken position around 22,300, and on the higher end 22,500 to 700 has attracted the call writing position. So this is the immediate derivative parameters that can be seen on the Nifty front. But the main concern will be with Bank Nifty, because Bank Nifty is on the verge of giving a very strong breakdown. With today's opening, I am expecting that it is near to the zone of previous swing low. So I am expecting that if it further dips towards the zone of 47,800 or 750 kind of a zone, then that will be a very concerning factor for our markets. Because if there is a breakdown in Bank Nifty, then majority of because it being a heavyweight counter, there can be a decisive sell-off in the private sector banks and NBFC, which has even supported the market in the past month. So that is a concerning factor for now. But again, for Nifty, near about 22,300 is the immediate support. But even breaching that zone, 22,000 comes into vicinity. So that is a concerning factor. I'm not having a bullish approach in the market. One should adopt a cautious approach, and any kind of bounce can be seen as an opportunity to sell the counters and book their profits also, not to carry forward positions in these markets and uncertainties.
Okay, not to carry forward your positions. Any bounce should be utilized to sell. But one stock that will once again hog the limelight today is IndusInd Bank. Yesterday, it hit a fresh 52-week low. Today, at least in the pre-open, it's showing a 10% gap down on the stock, and I'll tell you why. Because yesterday, of course, it was the whole CEO extension, tenure extension for the current CEO Sumant Katpalia. He got an extension for 1 year, and the board had given approval for 3 years. So that was one uncertainty, and because of which some brokerages had downgraded the stock, some had maintained buy rating but had cut their target price, and they had said that until clarity emerges, chances of a re-rating are extremely slim. There could be, in fact, further de-rating if there isn't any color on the next CEO pretty soon. But today, there is another bit of news, a double whammy, so to say. The management has said the profit and loss account will be impacted by around 1,500 crore rupees due to derivative portfolio adjustment. There's been some discrepancy in their internal review which they have discovered, and that will impact in the derivative segment portfolio, of course, that will impact 2.3% of their net worth, and that's quite a huge amount. And back of the hand calculation says 1,500 crore rupees. Of course, they have appointed an external agency to review and validate the internal findings, and that will be coming out, I think, within a year or something. Yes, I think the final report is awaited, and on the basis of that, the bank will appropriately consider any resultant impact in its financial statements. Of course, I beg your pardon, the closure of the external agency review will end by the fourth quarter. So that's another kind of setback for IndusInd Bank. We have the Morgan Stanley report on this particular stock, and they have maintained their equal weight call. Target price is at 900 rupees. And of course, they have noted the fact that 2.4% of net worth, that's the kind of impact that the company will feel. And of course, it's with respect to their forex portfolio. Aside of that, they have mentioned that visibility on stock continues to reduce. Over the past 3 months, the CFO had resigned. The CEO has now been given a shorter than expected tenure extension, and now, of course, this big loss in the derivative portfolio and all these factors not boding well. Morgan Stanley saying downside risk to numbers will be there post the company's disclosure. IndusInd Bank, 8 110, in the pre-open. That's the kind of level we can see. But, a fresh leg of breakdown on charts, and how further can it fall from here?
See, definitely there has been a very strong breakdown in this counter. Previously, it was hovering or making a support base near the zone of 950 to 1000, but the recent news has dampened the sentiments in this counter, and there has been a very significant plunge. In this week, the counter is approximately 15% down. So, on the broader time frame, the near term support which is visible for this counter is approximately around the zone of 770, which is the monthly closer of the June month in 2022. So that is the immediate support that can be in this counter. So 770 to 750 is the immediate support zone for IndusInd Bank. If there will be any kind of sustainability or stability around these levels, then we can see what further developments can be seen on this counter. But for now, the technical indicators are very weak for
All
IndusInd Bank.
right. Right, technical indicators very weak, and of course the first ticks coming in not pretty, as I had mentioned. 0.5% cut on the Nifty. 22,340 is where we are at the current juncture. It's a good 0.5% cut on the index. Sensex down 0.5% as well, 330-point cut. The mid cap index is down 1%. And the bank Nifty as well down 0.5% or thereabouts. So yes, it was anticipated that we will see, we will be reacting in line with the kind of global cues that we are getting this morning. But it isn't like a 1% cut, a 0.5% cut. That's what we are seeing at the current juncture. Whether or not it goes further south, we will wait and watch on that. But let's take a look at what the other sectors are doing. As I mentioned, the bank Nifty index is down somewhere around a 0.5% or thereabouts. Let's see what IndusInd Bank is doing before we move on to other sectors. It is 10% down on IndusInd Bank, as we were just speaking about it with Osho. Other names, not surprising, it's the tech names that are dominating the list of losers. Given the fact that we saw a 4% cut on the Nasdaq overnight, we were expecting a big cut on the IT stocks as well. Infosys, Wipro, Tech Mahindra, HCL Tech, TCS, all of these stocks are trading with cuts of somewhere around 1.5 to 2.5% or thereabouts. Let's take a look at the sectors then and see what the rest of the market is doing. IT not doing well, IndusInd dragging bank index down. And in terms of the other sectors, autos were among the big laggards yesterday. Today as well, it's a 1% cut coming in there. Nifty IT 2% down. Metals down 1%, all the sectors trading in the red, but at the current juncture, of course, the losses or the weakness being led by the IT pack. Let's see if there are any gainers or not at the current juncture. Just a handful of them, 5 to be precise. ICICI Bank and some auto names like Bajaj Auto and Maruti are trading with a hint of green. Sun Pharma, among gainers. Of course, it has made an acquisition recently. Stock has been in news, and today among the handful of gainers on the index. ITC, was a gainer yesterday because FMCG managed to eke out slim gains yesterday. Today as well, ITC and Hindustan Unilever trading with very slight cut, but yesterday both these stocks were in the green, and the FMCG pack today down 0.3%. So yes, no hiding space today. All the sectors trading in the red, and it's deep red that we are looking at right now on the screen. A triple digit cut, 111-point cut on the index as we speak. Any thoughts on what one should really be doing in this market? What should one buy or sell? Any recommendations, Osho? I know times of caution, but if you were to take a few bets, anything that you would like to point out for our viewers? Osho, I think you're on mute.
Yes, I was on mute. So sorry. So actually, the developments that has been seen from the last trading session, that the FMCG space have seen some kind of a positive momentum. There was some long build-up in majority of the FMCG counters like HUL and ITC. So looking at the developments in these counters, I expect that there is a possibility that counters from FMCG can see some kind of further development, positive development in themselves. So HUL is a good bet to go along with, although the market is very uncertain and one should not be very much aggressive, but again, looking at the technical and derivative perspective, HUL is having a decent development and has seen a kind of a long build-up in last trading session. So I'm expecting HUL can be seen as a long bet in these market conditions. Also, it is being from a defensive sector, so one should not be very much concerned about the kind of a fall that can be seen in this counter. So this is a good bet to take long on. Other counters that one can look for is where we have seen a major breakdown. So major breakdown has been seen in majority of the counters. Firstly, Infosys has seen a very strong breakdown. So Infy can be seen as a kind of a short selling or fresh sell-off from here onwards, because on the technical front, there has been a development of 1680, 1690 was the very crucial support zone from where we have witnessed a kind of a breakdown in this counter. So I'm expecting that on the lower end, 1610 to 1620 can be seen in this counter, while on the higher end, it is advisable to keep a stop loss of 1685 from short-term perspective. But in the day, there can be possibility of further movements in majority of the sector. So one should definitely keep watch on sector specific movement rather than index specific movement. So there can be ample opportunities from stock specific front for the day trader.
Okay, some names from the FMCG basket you can really look at. But let's talk about some other stocks that are in focus this morning. NTPC would be one. The stock has seen quite a bit of a correction, a 20% cut from its 52-week highs. But are there any signs of rebound? There is some bit of news flow. The company and its arm NTPC Green have signed agreements worth 96,000 crore rupees with the Chhattisgarh government, and the agreements of course include nuclear, pump hydro and renewable projects as well. But given the fact that it has already seen a fair bit of correction, are there any signs of a reversal on charts now? NTPC, what is your call there?
See, NTPC has been into a very strong consolidation. The last 2 months has seen a very strong consolidation around the zone of 310, 300 odd levels. And in the last 1 month, there has been a positive development. That means on the technical front, there has been a cycle of higher highs, higher lows in this counter. So I'm expecting that there is a possibility of reversal in the power sector. NTPC specifically is having a decent setup on the technical front. Till the time it is hovering higher than the zone of 310, one can look for long bit in this counter at current levels, or at for short term period or intraday levels. 320, 319 is a very strong support, while on the higher end, one expect a target of nearly 336 in this counter. But positionally, 310 is a very strong support, and I'm expecting that near about 355 can be seen as a target on positional basis.
Okay, that's about NTPC, but let's shift focus to some of the viewer queries that are trickling in this morning then. First one I would like to take up on Nuvama. The stock is down 6% as we speak, and we have a query coming in from Satya CK. He wants to know whether this is an opportunity for going, for a fresh long in the counter. The stock has seen a 25% cut on a YTD basis, but over the last 5 sessions, the pace of selling had kind of stabilized a bit. But today, again, it has seen a 5%, 6% cut. Do you see this as an opportunity to go long, or is it an avoid?
See, overall, this counter is into a very strong consolidation for the time being. It is hovering in a very strong range of nearly 5,000 on the lower end, and 5,600 on the higher end. So one should wait for the zone to get breakout. If there will be any sustainable buying that can be seen above 5,600 zone, then one can look for buying opportunity in this counter. Or if it plunges towards the zone of 5,050 on the lower end, then one can look for buying opportunity in this counter. Currently, it is having a very strong base formation for itself. So one should wait for the counter to give a very strong consolidation breakout, and then only can look for buying opportunity in this counter.
Okay, that's the view on Nuvama. Hope that answers your query, Satya. I want to take up a query on the metal pack. Tahir Tarzan has sent a query on Tata Steel. Metal pack has been in focus. Last week was great. Metal stocks were shining bright. Of course, once again, starting this week, we have seen renewed selling pressure. But given the fact that globally 25% tariff on steel and aluminium comes into effect tomorrow, unless there is some last minute reprieve, metals will continue to hog the limelight this week as well. In the middle of all this, would you advise a trade in some of these steel names, especially Tata Steel? And if somebody is looking to take a positional, looking at it from positional view, would you suggest right now, or would you suggest holding on for a bit?
See, this counter have seen a very strong resurgence in the last week. There has been a kind of a 7 to 8% kind of a movement in Tata Steel, and which is a very rare scenario. But looking at the overall scenario in this counter, then there has been a positive development from the zone of nearly 126, 128 zone, and there has been a kind of higher highs, higher lows. But currently, at these levels, the counter is hovering around the 200, the simple moving average, which is near about 151. So better to wait for some kind of profit booking coming in this counter near the zone of, one can look for accumulating near the zone of 145, 144, or if it breaches the zone of 200, the simple moving average on a decisive manner, then one can look to accumulate it, which will be approximately around the zone of 153 to 154. So one should keep these two levels in their mind. If there will be any kind of profit booking, then one should definitely try to accumulate from the zone of, in the zone of 144, 45, or above the zone of 153, because overall there has been a positional shift in this counter, and one can definitely expect a very strong reversal. And in the coming period, on a positional basis, I am expecting a decent upside movement of near about the zone of 168 to 170 from short term perspective.
Okay, that's the view on Tata Steel. I hope that answers your query. I spotted a query on the cables and wires space, which I want to take up with you. Naveen wants to know your thoughts on which one is a better choice between Polycab and KEI Industries. We've seen a sizable correction on these stocks ever since the news of Ultratech coming in and disrupting the space came out. Do you think that should be utilized to get into some of these counters? Of course, on a positional basis, which one would you really prefer looking at the charts, Polycab or KEI Industries?
See, overall, a Polycab has seen a kind of a breather, or has undergone through a kind of a corrective phase in the month of January 24, where the counter have plunged towards the zone of 4,000 and again have started the rally. But in the case of KEI, there has been this is being the first scenario where the counter is into a corrective phase. So technically speaking, if I have to choose between these two counters, at current levels, both of the counters are not looking very lucrative. So one should wait for further dip or a kind of a consolidation happening in this counter. But comparing between these two counters, then I expect Polycab has a better outlook on the technical front, and I expect that there is a possibility of higher returns as compared to KEI in the coming period. So one can look for Polycab, but not at current levels. If there will be a continued sell-off, then the zone of 4,500 to 4,400 will be a decent zone to start accumulating this counter. Or if there will be a kind of a reversal, then the zone of nearly 5,180 to 5,200 odd levels will be providing a very strong momentum to this counter.
Okay, that's the view. Wait it out. That's the call when it comes to the cables and wires segment. A couple of queries then I'm spotting on our feed. One is on IndusInd Bank, Kamalaja. Kamalaja, we've already discussed IndusInd Bank. I'd like to take up your query on Hero MotoCorp. What is the correct time or price point to buy Hero MotoCorp? That's the query from Kamalaja. Okay, so Hero Moto, of course, two-wheeler stocks have been under pressure. There's no denying that. But the last 5 sessions, if you look at the cumulative returns on a Hero Moto, it is still positive. Of course, last week we saw a recovery in the market as well. But price point wise, is this a good time to get into a Hero?
See, technically, the support is approximately around the zone of 3,150, 3,200 odd level. So there is a possibility of further 300 points of correction in this counter. While in the meantime, if there will be any kind of reversal which can give a breakout above the 20-day exponential moving average, then only one can look for buying opportunity in this counter. Else, should maintain patience for another 300 points of correction, and around the zone of 3,200 to 3,100, one can look for buying opportunity in this counter, because currently there has been no pullback or no sign of respite in this counter. The counter has been hovering below the short-term moving average. So there is no technical parameters that can signal for a buy in this counter. So better to wait. If there will be any further correction towards the zone of 32, 3,100 levels, then try to accumulate. Or if there will be any kind of reversal which can give a sustainable buying emergence above the
Right.
20-day exponential moving average, then one can look for buying opportunity.
Hmm. Okay, that's the view. Wait it out before looking to hitch a ride on Hero MotoCorp. That's your answer. The next one, I want to take up a query on Supriya Life Sciences. In fact, I want to take up a query on Supriya Life and Nectar Life as well, because that counter is in focus. It has been hit with 7 European regulatory observations, out of which I think 5 of them are of critical nature. In fact, 4 of them actually are of critical nature. The stock is reacting 5% down, and we have a query on Supriya Life as well. Nitin Shahji has sent this query. How are these two stocks poised on the charts? Do you see, more downside going forward, or do you think, play it out and maybe just get into some of these counters? How would you look at the entire life science space right now?
See, overall, comparing these two counters, then Supriya Life Cycle is into a decent phase of technical front, because the counter, although the counter has been into a corrective phase from zone of 800 towards 600 now, but it is placed at a very strong support of 200, the simple moving average. So I'm expecting that the zone of nearly 580 to 590 should provide a very strong cushioning to this counter. Previously, also the counter have seen a kind of a movement or towards the zone of 520 from there, where we have seen a kind of a positive momentum. So I'm expecting that comparing these two counters, this is having a better technical setup, and one can look to accumulate on a lower end near the zone of 580 from a medium term perspective. Overall, the technical outlook for Supriya Life Science is looking more better than the Nectar Life Cycle.
Okay, that's the view. So, Supriya Life Sciences looking good on the charts. I hope that answers your query, Nitin. We have a query on a CSB bank from Rupak Mehta. Hasn't really mentioned the time horizon, but the stock hasn't done all that badly, given the fact that we've seen a sharp correction in the market in the last 1 month. The stock has seen a 2% cut, in the last 1 month. How is the CSB bank looking like on the charts? Is it worth a play?
See, technically, this counter lacks very less momentum, because there has been no strong traction seen in this counter in the last 5 to 6 months. But overall, this is into a corrective phase. The counter is looking a kind of a continuity into the lower end. So I'm expecting that 265 to 260 is the zone where it should get some kind of breather or can halt the selling pressure, and from there onwards we can see some kind of higher movement. But on the front of liquidity or volumes, it is having a very low volume, so that might be an issue for this counter. So if one have the position or one wants to hold it for a long-term perspective, then only look for buying opportunity in this counter.
Okay, that's about CSB Bank. One query then on a DLF from Debu K. Realty stocks, they were beaten black and blue in this leg of the sell-off since the start of the year itself. Looking at DLF, I can see the stock is down somewhere around 1% or thereabouts right now. From its 52-week high, it's come off quite a bit at 640 or so. It's very close to 52-week lows, in fact. At 640, 45, is it worth a look? Do you think the risk reward is looking a little attractive now after the correction?
Yes, looking at the risk reward perspective, yes, the counter has seen a very decent correction and it is looking now positive also, because on the technical front there has been negative divergence. That means the prices are moving on the lower front, but the indicators are having a higher lows in on the parameters. So I'm expecting that in the coming period there is a possibility of reversal in this counter, but one should wait for DLF to cross over the zone of 20 exponential moving average, because the last 3 attempts of moving beyond the zone of 20-day exponential moving average has been failed. So once it stays above or sustains above the zone of 20-day exponential moving average, which currently is around the zone of 680, then we can see a decisive reversal in the coming future. So one can definitely keep this counter in their watch list. The time it surpasses the zone of 20-day exponential moving average, one can definitely try to accumulate it from a short to medium term perspective.
All right, that's the view on DLF. With that, I'm afraid we've come to the end of the query segment. Osho would like to thank you for taking out time and joining in and sharing your thoughts with us, and of course, helping our viewers navigate, their holdings as well. Look forward to more interaction in the future as well.
Thank you so much.
Thank you. On that note, take a quick look at the market. It's 0.5% down yet, still a 100-point cut on the Nifty. Advanced decline ratio, although, has worsened. It's 1:6. That's the NSE advanced decline ratio at the current juncture. Mid caps, although, have pulled, have kind of pulled back a bit from opening lows. 0.7% kind of a loss on the mid cap index. But on that note, let me bring on board the big market voice that I had promised at the start of the show. Joining me is Vinit Sambre, Head Equities, DSP Mutual Fund. Vinit, lovely having you on our show, and that too on a day when there's so much to digest, right? There's been a sell-off across asset classes overnight. Equities, crude, gold, Bitcoin, and of course the massive tech sell-off as well. Plenty going on, and it all originated, in fact, from the comments from U.S. President on a possible U.S. recession. He didn't rule out one. So the big question is the U.S. manufacturing a tariff-induced recession? Do you think that's on cards?
So, good morning and thank you for having me on the show. So, I think you actually touched a very important point. What about the fears of U.S. recession? So in my mind, I think today what is happening is that because of the policies around the tariff restrictions and other areas which the government there is trying to enforce, I think it is causing a lot of confusion and uncertainties in the minds of not only the people out there but also the corporates out there. And I think the impact of that we have started seeing in terms of the US markets as well over the last few days where the markets there are also weakening. So I would say that what fears we had, I don't know whether it will be recession, but definitely it is calling for this uncertainty is calling for some kind of slowness out there, weakness out there. Uh, Companies, people should be confident to sort of invest and grow, but I think that is something which can come under some bit of a check, is what I feel. And if we have the largest market sort of slowing, I think that will have its own repercussion on the other markets as well. So I think we have to be a bit cautious at this point because of all these uncertainties. Until the time these uncertainties don't go away, I think we should see weaknesses across not only equity markets but also different asset categories, like you mentioned.
One more point, Vineet. US is faltering, but can India benefit? Because we have the crude tailwind. Brent crude is sub $70 now. Dollar is faltering as well. Back home, growth has bottomed out. Inflation front as well cooling off. We have the rate cut cycle that has started. Can FIIs now turn to India? We have seen a decent valuation correction as well after coming off 15-20% from the peak.
Yes, so I think a couple of months back, the big challenge with the FIs were the valuations at which India was trading at. And from there, those high points, definitely we have pulled off. And the valuations, when one is looking at the Nifty, looks pretty reasonable at 18 and a half times 1 year forward. So I think from that perspective, it definitely makes a case. But when one looks at the internals of the market, I think the internals of the market still suggest that beyond, let's say, the banks, which is the large segment, a lot of the other segments have not seen valuations cool off to levels which one would call them very attractive. That is point number one. And the other factor is that people would like to look forward to some visibility of some triggers as far as the growth is concerned. While all of this is happening, but at the same time, we have seen the corporate earnings downgrade has really started, and maybe we'll have 1 or 2 quarters of downgrades continuing. I think till the time we do not see the visibility of the earnings growth sort of coming back up, I think there will be some kind of tentativeness in terms of the investors. But to your point, I would say what are the positive factors which have started emerging. One, definitely RBI is turning out to be more supportive of growth, where they have induced liquidity in the system. Interest rates are sort of, like you mentioned, is sort of favoring us. And more importantly, the benefits of what the government wanted to push, the consumption, because of the tax benefit which they have rolled out in the budget. Once the benefit of that also starts accruing, maybe 1 or 2 quarters down the line, and a low base is formed in terms of the result season, I I would imagine that we would start seeing some bit of visibility of growth from there on. And hence, I would call for 1 or 2 quarters of maybe weakness or uncertain period during which time investors may want to redesign, reshuffle, or rebalance their portfolios and align to their long-term thought process.
How much more downside can we expect from here now, Vineet? Do you think we've seen the worst of it? We've preempted all the bad news. We are closer to the bottom, or do you think there's still some time to go before we hit that bottom? Your thoughts?
Yeah, no, so I think it's very difficult to call out see, we are trying to do a lot of this analysis around the previous falls. And if we look at the historic falls that has happened, so the big falls actually are followed by, some of the other events, like, you had COVID, before that you had Lehman crisis, the taper tantrum and all of that. This time, a lot of the correction we are seeing is, without any big event actually happening. So whether this the correction itself drives or leads into some event which is maybe sentiment led or liquidity led, I think that is also possible. But if we have that, then I think, as as we say, that pendulum swings on both ends. It has swung on one side in a big way, and then maybe we are somewhere a midpoint. If it has to swing, it could, because of the poor sentiments maybe. But I would imagine, when I look at the market valuations, I look at the internals of the market, even from the small and mid cap perspective, more than 50% of the stocks have actually corrected by what the index is showing. So let's say if the small cap index is down by 25% from the top, more than 50% of the stocks are down by more than 25% or 30%. Same is the case with mid cap. So I would say that in a lot of the pockets, the valuations are maybe reasonable. In some cases, they are still on the mid point or slightly on the high point. It is still not very attractive. But I think selectively there are pockets which are looking like, seeming very attractive from the valuations viewpoint. And I think looking at those or exploring those options are also one way to look at it, and maybe have patience till the time the uncertain period ends. So I think that is how I would sort of think.
Which would those pockets be, Vineet? If I ask you to break it down for us, where you are finding valuations looking a bit attractive?
Yeah, so see, actually, one of the areas which were actually looking very attractive to people just maybe 1 year back were the PSU pack, and now suddenly, because of post-election, I think it has lost some of that charm. But I would say that companies within the banks or the OMCs, now they are trading below book value, so which is, I think, a good starting point to look at them. Maybe the outlook may not be great, but the valuations viewpoint is pretty okay. Engineering and capital goods sector, especially linked to the power sector, was something which was again in the limelight and had seen exuberant valuations. Within those, there are a couple of companies where we are seeing the valuations have come off significantly and are trading at long range attractive valuation zone. So maybe point to look at those. Building material overall as a category has had not participated in a big way in the rise, and I believe that a few stocks are actually cracked down to again their long-term averages in terms of valuations. So one can actually definitely focus on those. I believe that banks and NBFCs uh, are likely to go through a bit of a challenging period over the next 1 or 2 quarters because of all this asset quality and maybe the NIM pressure. But after that, I think there could be a good base formation for those, and could be a pocket of opportunity to be looked at. So I think these are some of the areas which sort of are coming out in terms of the purely from the valuations viewpoint.
Another pocket that I want to talk to you about is the entire summer theme. Do you think with summer approaching, rising demand for power, ACs and coolers create pockets of opportunity as well?
Yes, I would agree to that, because there are a combination of two factors. One, anyways, the penetration of, let's say, the air conditioner and the allied categories is pretty low, and the summers in general, they have been pretty sharp, and hence that I think is leading to the demand momentum remaining strong during those periods. And added to that is the benefit which the consumers are likely to see due to the tax reduction which is happening. I think that should lead to a combination of good growth, not only in these categories. I'm assuming that some of the other categories like QSR, which has been lying low in terms of the demand momentum, could see some bit of comeback. There could be other discretionary categories we are watching. Those could also benefit. But overall, I think the view is that consumption as a category has seen slowdown over the course of last 1 or 2 years. And this was both a combination of the rural side and now of late the urban side. My belief is that the next leg of recovery in the earnings growth could be led by the consumer as a category, maybe not now, but 2 quarters down the line, as some of these benefits actually percolates down and people start spending. So I think that is one of the other thoughts and or views which I have.
Anything on the quick commerce space? Intense competition. Would you, rather stay away right now?
So, see, I think beyond competition, which is, I think, going to be the norm for them, because new and very strong players are actually looking to enter this market. More importantly, it is the path to profitability, which is looking pretty weak, and maybe it is getting accentuated because of the competition which is happening right now. So maybe once the path to profitability becomes clearer, or the this whole competitive high competition actually settles down, I think that could be the point to look at those, because anyways the growth metrics for them tends to remain high, and the adoption of quick commerce is taking place. So there is a need, and they are addressing that need. But that need is not actually resulting into conversion to profitability or ROEs. Maybe once we have a visibility of that, that could be a point to look at these companies. Yeah.
Sure. Last couple of questions, really, Vinit. What kind of changes have you made in your portfolios since the start of the year in this leg of the sell-off, and which are the pockets that you're completely avoiding at the current juncture?
Yeah, so see, in line with the thoughts which I just shared in terms of the sectors, categories, stocks, I think that is what we are trying to do. We were, earlier 6 months back, we had a higher exposure to engineering and capital goods category, but we have over a period of time reduced that exposure, and that was a timely call, because at those points they were trading very expensive, and that's a call we took, that both in terms of the business cycle and the valuation cycle, they were trading expensive. So we reduced, and there I think we are cautious. We are very selective. Only if the stocks are coming down to very attractive levels, we would look at those. Beyond that, we have been marginally changing our positioning, where we find the stocks are on the expensive side. We are just trying to move to where we find the valuations, let's say, remaining more attractive. So in line with that, as I spoke, building material is one of the categories which we are focusing on. There were a couple of these PSU banks which I looked at. The metals is a space which is at the lows today. So I think we're just trying to figure out where the businesses are at the lows and trying to shift the portfolio in that direction. And maybe when the market stabilizes, we'll have some of these businesses likely to do well. We are also incrementally looking at NBFC as a space, because, as I said, I think they will go through 1 or 2 quarters of pain period, and beyond which, I think as the interest rate comes off, that will be one of the categories which will see the benefit, and they are again at their historical lows when it comes to the valuations.
Sure. One last question, really, Vinit. Any advice to the young investors, given the fact that, the post-COVID investor has only seen a one-way move in the market, right? And that's been up. But people who are new to this sell-off, any advice to them?
So, see, I have actually, we've done a lot of sharing of information about our own journey during the Lehman crisis. And we had seen almost 70% cuts in somebody who had invested in our small cap fund. It was known as micro cap fund, and actually it took almost like 6 years period to sort of come back in terms of the base capital. And in the seventh year, the returns which people saw were almost, let's say, close to 15 or 16% CAGR, which means that sometimes the patience gets tested a lot. And the other aspect was that somebody who had still continued doing SIP in that period, even during a phase where the lump sum could have not generated return, but let's say 2 or 3 years or 4 years, there was a positive trend in their overall returns outcome. So I would say that these are the norms for the market. Markets will see volatility just that last 3 years had not seen, which doesn't mean that the nature of the market has changed. I think we will go through these volatile times. The best part is to stick to your asset allocation strategy. Don't take extraordinary risk. Generally, in bull markets, many times the bad quality asset appears good and they attract investors. I think that's where one should sort of try and stay away from those temptation maybe. And if one is invested into good quality assets and good quality businesses, just stay through, have more SIP format of investing and sit through the volatility. Maybe once things emerge well, I think the outcomes can still be quite satisfactory. Because at the end of the day, I think India
All right,
is a
that's
growth
great advice.
economy and a growth market, and
Sure.
hence one cannot lose the sight of long term where eventually equities are likely to generate decent returns. And the interim is something which one needs to maybe take care of and have patience.
All right, have patience and ride through the storm. Of course, India is a long-term story. That's the view from Vinit Sambre. Vinit, lovely chatting with you, and that too on a day when we are seeing a fair bit of correction and there's a lot of turbulence when it comes to global markets as well. Would like to thank you for taking out time, and I look forward to more interactions with you in the future as well.
Thank you.
Well, that of course. Take a look at the market. We are off opening lows, down 70 points on the Nifty, coming close, edging close to the 22,400 mark. The mid cap index has also come off its opening lows, now 0.5% down or thereabouts. The breadth, however, remains poor, 1:5. That's the NSE advanced decline ratio. And IndusInd Bank, this stock, of course, is hogging the limelight, down almost 20% as we speak. Sub 750 levels, double whammy of sorts in a matter of 2 days. Earlier it was the CEO extension, the tenure of the CEO extension that was an issue, and today of course there is accounting discrepancy in its derivative portfolio that could impact of course 2.4% of its net worth. That's roughly coming to around 1,500 crore rupees or thereabouts. Of course, the stock bearing the brunt, 19% cut as we speak. Well, with that completely timed out on this edition of Opening Bell. If we couldn't take up your queries, don't worry, keep them coming in. Send them to us tomorrow. We'll try and get them addressed. But please keep them coming in. We are here to help you navigate your holdings. With that, of course, thank you. Thanks a lot from the entire team for watching the show. I'll see you at 3:30 p.m. When we come back with Closing Bell. Have a great day.